Hello, everyone, and thank you for joining us. My name is Laurel Page, and I am the Assistant Director of Events at the University of Colorado Boulder's Leeds School of Business. Welcome to our 8th webinar series. These continue to be trying times, and here at CU Boulder, we have gathered our world-renowned faculty and alumni to provide frank and timely insights. Today is the 5th of 6 webinars in this webinar series. To view upcoming webinars, please visit colorado.edu/business/alumni. Click the drop-down arrow and click Attend Online Webinars. For today's webinar, we're excited to welcome Brian Lewandowski and Richard Wobbekind, here presenting Economic Recovery Taking Shape. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Brian and Rich, please send a question through the Q&A interface. We will monitor questions as they are submitted, and Brian and Rich will respond to them at the end of the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speakers. If you experience any technical difficulties during the webinar, please notify us through the chat interface and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants tomorrow, along with a survey link and supplemental resources from today's presentation. Now, I am excited to introduce today's speakers. Brian Lewandowski is the Executive Director of the Business Research Division at the Leeds School of Business, University of Colorado Boulder. Brian provides regional business and economic information and education, including economic and revenue forecasts, policy studies, economic impact analyses, and data workshops. Brian has 13 years experience conducting economic studies at CU Boulder. Prior to CU, he worked in both the private sector and government. He is past president of the Denver Association of Business Economics. Richard Wobbekind is Associate Dean for Business and Government Relations, Senior Economist and Faculty Director of the Business Research Division at the University of Colorado Boulder. He joined the faculty at the Leeds School of Business in 1985 and has served as an Associate Dean since 2000. As Faculty Director of the Business Research Division, his responsibilities include developing an annual consensus forecast of the Colorado economy and performing various economic impacts assessments of the Colorado economy. Wobbekind also produces the quarterly Leeds Business Confidence Index for Colorado. Rich is the past president of the National Association for Business Economics. Welcome, Brian and Rich, and thank you so much for being here. I'm going to hand the webinar controls to you now.
Well, thank you, Laurel. And it's great to be here with you again. For some of you, I'm sure this is the maybe 4th of these we have done over the last year, starting back when the pandemic hit and trying to make sense out of the economic downturn and the road to recovery. And as you can see from the title of this slide, we're talking about a recovery taking shape. Couple of significant things have happened. I think most significantly, the escalated rollout of the vaccine, but also the stimulus packages, which we'll talk about here in a moment. We've divided this up into 2 presentations, connected but separate. I'm going to talk about the national economy up front and sort of set the stage. And then Brian is going to talk about the state economy. And we should have ample time for Q&A. So with that, let me start to have you see some of the issues that have been out there. So we started off with this incredible downturn you're all familiar with, an incredible uptick in the 3rd quarter. And at that point, things seemed to be growing, but at a little bit slower pace, if you will. And the thought was at that time that it would take, back in the 3rd quarter and into the 4th quarter, People were suggesting that we wouldn't hit the same level of GDP until the end of 2021 or probably well into 2022. But several things have happened since then, as you know, and we'll talk about here in just a short moment. In addition, we saw this incredible drop off in employment, and we have seen a bounce back in that. But still at this point, we're down about 8 million jobs in the overall economy. So we want to talk about that whole piece as well, and kind of more of, in this particular case, the check mark or swoosh type of recovery, and where do we go from here? So those who have been hearing this before, we said from the very beginning that it wasn't going to take anywhere near the amount of time to recover the jobs as it took in the last recession, in the 2008 to 2009 recession. However, until just 2 months ago, we were at a lower percentage, if you will, a greater percentage of job loss than we ever reached in that last recession. So we had 2 months ago, we were still down 6.5% in terms of jobs. Now, with the last 2 months of employment numbers, with the reopening of the economy, we're down 5.5%. So it's looking increasingly like we will be seeing, a road to getting back to the same level of jobs somewhere in the end, or probably somewhere in the middle, perhaps, of 2022. We get strong recovery in 2021, but we'll probably not get back there till mid-2022 or the latter part of 2022. Well, that sounds like a long time, but compared to what we were thinking going into this, we were talking 2023. So we certainly have seen an escalation in the job recovery, very much associated with stimulus and associated, again, with the vaccine rollout. So the current numbers are supporting at the national level a 6% unemployment rate. And while that is not a desirable rate over the long haul, we went into this particular recession at 3.5% unemployment rate. It's still commendable to come down to that kind of a number in such a relatively short period of time. But unfortunately, one of the reasons we came down to that level will be illustrated on the next slide. I'll talk about that a little bit more. The other sort of troubling piece of the unemployment, not just the sheer number, but it certainly impacted different groups in the economy. So when you look at this particular chart, just sort of the highlight here, the red bar is the peak unemployment back in April or May of 2020. We have February of we have March of 2021 is the tan number. And you can see in the green bar where we were going into the recession. So green is before, March, April is April, May is the red, and the tan is where we are right now as of March. So you can see the dramatic recovery in virtually every category when you look at the pieces. In particular, I would highlight for those on watching the programming today, the bottom bar, which is college degree or higher. We have the lowest rates in the country in that bracket. So yes, it had an impact, but it has recovered dramatically, and the unemployment rate there is less than 4% for those with a college degree. But as mentioned, it did impact the young disproportionately. It impacted certain ethnic groups disproportionately, and it has impacted women disproportionately. And you know many of the reasons. So when we look at the recovery, we want to be paying attention to those different categories, and we want to be paying attention to the participation rates. In particular, part of the reason that the unemployment rate is down at 6% nationally is that we've seen a significant drop off in labor force participation. So you can see that documented on the right-hand side of the graphic, the total number, the men in the tan at the top, and women in the sort of darker piece in the bottom. And you can see in all the categories, we've had a significant drop off. There has been some suggestion, as I mentioned a little bit earlier, the impact of this particular recession on female workforce, some of which was caused by the types of industries that were impacted, healthcare and retail and leisure and hospitality. But some of it was certainly related to the stay-at-home schooling and other home care provisions that needed to be provided, typically fall disproportionately on female members of a household. Well, moving along, what's happened that has moved up the GDP forecast? I mentioned that we were talking about the GDP not getting back to peak until before we were talking about it not getting back to peak until late 2021 or 2022, well into 2022 on some of the forecasts. Now we're talking about GDP getting back to the same level in the third quarter. And we're talking about employment getting back to the same level, roughly a year and a half out from right now. Well, here's what happened. We saw a tremendous amount of stimulus, which is highlighted on the next graphic. And when you look at the differences in forecast for these various categories, we've taken the time to detail them out on the in the left hand in the text box, if you will. Bank of America increased their 2021 expectations for real GDP from 4.5% in December to 7% in April. And they're not even the highest. We see others that are even higher. Wells Fargo raised their estimates for personal consumption growth from 4.9 to 8%. JP Morgan, real business investment, 3.8% to 8.7%. And we've also seen, in conjunction, the upward revisions to the yields on 10-year treasuries, something I'll talk a little bit more about in a moment. So you see this incredible increase in disposable income and also in business investment, overall GDP, and personal consumption. And what you see in the graphic is the consensus numbers for these. So the consensus number, for example, for GDP is 6.2%. Tremendous growth we haven't seen in for a year in 40 years or so. So when we look at the relief measures, this is what is basically astounding. You can see the first sort of $2.5 trillion with the CARES Act, and we've documented here the stimulus checks and the jobless payments, and then expiring, and then the reinitiating of the stimulus checks again, and the $300 weekly jobless payments. And now we see in the most recent stimulus package another $1,400 more in stimulus checks in the Biden plan, so-called American Rescue Plan, and the continuation of those extended higher levels of federal unemployment benefits until September. So if I wanted to be controversial, I would say, and I oftentimes do, did we really need this last stimulus in the way it came about, given all that we're seeing at this point in time? It's easy to criticize in hindsight, but we didn't know at the time we were going to see such an incredible surge in the rollout of the vaccine. And that, of course, has had a dramatic impact in and of itself. So moving along, income and consumption, again, you can see revised totals here. We expect personal income up 3% in 2021, and then falling off without all of the additional stimulus in 2022, but driving this incredibly high level of personal consumption in 2021, and still with pent-up demand, having good consumption levels in 2022 as well. Part of what's being driven up, of course, is household wealth from the stock market, from housing assets, from this incredible amount of liquidity and stimulus really pumping up markets. We've also seen very positively loan delinquencies being very muted. Now, some of this is legislated, if you will. Student loans, for example, have been put on hold in terms of the payments. You can make a payment, but you don't have to make a payment. So you would expect, of course, delinquency rates to drop significantly. But in these other categories as well, we've seen very controlled delinquency rates. A little bit of a bump up in a couple of the categories, but now you see them slowing down. So this is a good sign in an economy that just came through this incredibly high, unemployment, and still has significant unemployment. And again, certain categories of employees are still struggling with the recovery. This chart illustrates personal income, savings, and consumption. And you can see these personal income numbers surging every time we have a stimulus check in the top box. You can see the consumption numbers also actually move positively with the stimulus, with the income jumps, but we're also seeing a very big jump up in terms of savings rates. So the savings rate is sort of thwarting a little bit the recovery in terms of people spending the money. Instead, they're saving the money. And there is some question of whether or not this is what's driving up certain types of asset values in the US, all of this additional savings, as opposed to particularly upper income families, but also middle income families using that money for savings and investing into stocks and other assets, as opposed to personal consumption to get the economy back on its feet. We'll see whether or not that continues now that we have the restaurant rollout, now that we're going to be able to see more tourism as the tourism picks up. So we'll pay close attention to that. Moving along, you can again see the surges in retail sales. March retail sales are up 27.7% year over year. Of course, March was part of the shutdown month last year, the second half of the month. So you have to be a little bit careful about that. But nonetheless, we're still 9.8% up from the prior month. So we're continuing to see very, very strong retail and food sales. And again, pent up demand being illustrated. One last comment before moving into my last few slides here. Confidence extremely high. Consumer confidence is doing well, but business confidence is soaring, very consistent with those large investment numbers that we saw in the very early slides. The confidence index at 65 for manufacturing and up in the almost 65 level for the services sector. So business is feeling really positively about the recovery. This, of course, bodes well for the capital expenditures that I already referred to, but it also bodes well for hiring. So these are very important pieces in terms of getting the economy back to whatever the new normal is. An area of concern now and going forward, and there were some questions submitted in advance about this, is the accumulation of debt that we're seeing between 2020 and 2021. Additional significant money going to the budget, which is in fact raising the deficit well above 100% debt to GDP ratio. What does that mean for the future? Well, we can talk a little bit about that, both in terms of economic growth and potential inflation. And the Fed, of course, purchasing a chunk of this with their asset purchase program. They will, at some point here in the not too distant future, in my opinion, really start to slow this down. But we'll see. Chairman Powell is feeling very strongly about the growth in the economy and is very sort of bullish on the economy, not just this year, but the years going forward. So we'll see. Even though they have been staying to the line that they're not going to raise short-term rates, got to anticipate that that's going to at least have some impact in terms of asset purchases. We have seen, as I mentioned earlier, this uptick in the short-term and longer, not short-term, but the 10-year note, which and also the 30-year year mortgage. This in line with, I think you could argue, higher inflationary expectations, but still at extremely modest rates in any sort of historical context, as you can see. If you look at that middle blue line, and even with this uptick that we've seen, look back to the left and look at it's rarely as low as it is even now when you go back over the last 20 years in history. So we do stay focused on the inflation rate. There have been some signs recently of inflation being a little bit higher in the economy. Unfortunately, what we are seeing is that inflation is higher in the Denver Boulder area. Denver, the measurement of quote Colorado inflation, and this has been true for every year, and it remains a concern in the competitive balance in terms of Colorado and the Denver Boulder economies. Talk more about that in Brian's presentation, which is coming up in a very short moment. Lastly, in this section, I just want to mention that this is one of the great unknowns as we go forward, telework due to the pandemic. And you can see that the different industries, what the pandemic peak was and where they are now as of March 2021. This is a survey that's done by the BLS on a monthly basis. We saw that, as you can see, trending down, bumped up a little bit in sort of when we had the outbreak in November, December, but you can see also trending down again. Still, at the end of the day, are we going to see, the norm being 20% work at home compared to what we had going into this? So it is one of the unknowns that affects real estate, public transportation, and other things that we can talk about more in the Q&A. So with that, I'm passing the baton to my colleague, Brian, who's going to talk to you about Colorado population, employment, and the economy.
All right, thank you, Rich. With that national backdrop, I'll walk us through some more local observations. So for those of you who know me, you know how I love to benchmark. I like to benchmark Colorado against other states. I like to benchmark our metropolitan areas against other national metro areas, because it's just really useful to see positionally where we are in the recovery. And I think this slide shows it pretty well, where we've been lagging in some areas and we've been leading in other areas. So this sort of illustrates how Colorado is doing. And so certainly if we take a look at something like employment growth, Colorado ranks 30th, we're at minus 4.8% year over year. If we take a look at the unemployment rate, Colorado ranks 34th. So we have slightly higher unemployment rates than most other states. Even our home price index, we are lagging the nation, but that's even with pretty swift home price growth. But then at the same time, we're leading in other areas. So a metric like real GDP growth, we were ranked 7th in the fourth quarter of 2020 at about 4.5% annualized growth. Our labor force participation rate is 3rd, and that really speaks to favorable demographics that we have in Colorado. And our labor force growth rate was 1st in the country. So this sort of shows that people are jumping back into the labor force. And our labor force participation rate, it's sort of interesting to take a look at it pre-pandemic versus where we are now. We're only 0.3% down from that little peak before heading into the recession. So really, in some respects, we're leading, and in other respects, we are lagging in this recovery. In terms of population growth, we went through a pretty robust period of growth over the last decade, and these growth rates have come down. Right now, we're looking at the slowest population growth rates that we've seen since the early 2000s, and notably the slowest net migration rates, where fewer people are moving into the state at a slower rate than they were just a few years ago. But I think what's really interesting thinking about during the pandemic is, what does this mean for shared growth, more broad growth around the state, and what are some of the opportunities for some of our rural areas, both rural resort areas like the mountain communities, as well as some of our agricultural communities. this work from home trend, work from anywhere trend presents a real unique opportunity for some of these places that have had slow growth or negative growth in population over the last 10 years. It's an opportunity for them to attract some new people to their community and reverse that trend. In terms of employment growth, when we take a look at Colorado compared to the United States, the slide really illustrates this breakout point for Colorado. We were sort of in line with the U.S. Coming out of the tech bubble burst of 2001 and that recession. But then from the Great Recession on, we had this breakout moment where Colorado started to really outpace national growth. And in fact, over the last 10 years, even including this pandemic recession, over the last 10 years, Colorado's employment growth was about twice the nation's growth. We grew at about 21% versus about 11% for the nation. And you've heard me say this before, for the 10 years leading up to the pandemic recession, Colorado had the fourth best employment growth in the country. We were certainly knocked off our rails because of the pandemic recession. This dropped us in our ranking. Now we can measure employment growth year over year as of March. And our growth rates, our ranking isn't quite as stellar. I mentioned a few moments ago that we're 30th in the country. We're minus 4.8%. But I think what's kind of interesting here is if we take a look at the surrounding states. So just to the west of us, Utah is second in the country with about 0.9% growth year over year. They're above their prior peak. We're still well below our prior peak. Idaho is leading the nation, also above their prior peak. They're up about 1.4% year over year. Those are the only two states that are really above water. But looking more in the Rocky Mountain region and even sort of the Midwestern Plains areas, Montana, South Dakota, Nebraska, they're all rounding out the top five. So we're sort of flanked on all sides, except for Wyoming, which is pretty much on par with how Colorado is doing, disproportionately affected by the energy prices. So in December, we presented our economic outlook for 2021. Our committees were projecting growth of about 40,000 jobs. Of course, we've gathered a lot more information by now. We've seen how the recovery is going. We've seen how the vaccine rollout is going. And our economic model has turned more optimistic, sort of like how Rich was sharing at the beginning, how the national models for GDP have sort of turned more optimistic over the last few months. So now we're projecting about 90,000 jobs in 2021. And you can see that confidence bound that we have here, but even the low end of the confidence bound at about 70,000 jobs is still really positive for Colorado. It's still a really good outlook. But you can see that on the high side of our confidence bound, we're up at about 120,000. And next year in 2022, we think that there could be about 140,000 jobs added in the state. And so all of this has to do with timing. And as I'll show you in a moment, all of it has to do with growth in a couple of key industries. But before we get there, let's take a look at where growth is happening around Colorado. So a few years ago, we would talk about the North Metro Front Range, Denver, Boulder, Fort Collins, Greeley being the leaders not only in the state, but being the leading areas really across the country. And that's not really true anymore. As I mentioned, Colorado is lagging, and so are our metropolitan areas. So Colorado Springs and Fort Collins, those are the two MSAs that are in the top half of the country, still losing jobs year over year, but sort of outperforming the average, where Greeley and Boulder are sort of in that bottom quartile of growth. Okay, so this is all year over year as of March. And when the April data comes out, you're going to start to see much better numbers because April of 2020 was the worst month of the pandemic. That's really the month where we lost all of the jobs. So now we're going to be talking about positive growth rates year over year in just a month. So it's going to sort of skew the story that we tell a little bit. But when we try and take a look at how communities are performing at a more granular level across the state, the story has also morphed over the last year quite a bit. So early on during the pandemic recession, you heard us describe our mountain resort communities as really suffering the most at the very beginning because our key tourism industries, our ski resorts, our hotels, really came to an immediate stop during the early days of the pandemic. So those industries were just really shut down at one of the key points in their season. And we had double-digit unemployment rates in those communities, places like Summit, Eagle, and Pitkin counties between 20 and 30% unemployment, just phenomenal rates that we have never really seen. But now we've seen a real collapse in those unemployment rates. Really, every place in Colorado has an unemployment rate under 10%. We've seen the mountain resort communities do a little bit better. We see the southern part of Colorado have higher unemployment rates now. We still see our lowest unemployment rates in our agricultural rural corridor along the eastern plains. But you can see places like Summit County now are at 4.4%. Eagle is at 5.1%. Boulder is at 5.5%. Broomfield's at 5.7%. So these rates really are getting much better. So back to benchmarking for just a second. When we take a look at industries, so this is showing each of our industries ranking among the 50 states. So the very first industry on this chart is management of companies. This industry is really representing company headquarters, and our company headquarters industry in Colorado is 4th best in the nation. So all of these gold bars are basically better than average. All of the red bars are a little bit worse than average. So our wholesale trade sector is 6th in the country. Manufacturing sector is 24th best in the country. But then you can see some of these sectors that are sort of underperforming the national average, including our accommodation and food services, including professional and technical services, which is one of our key high-tech industries in the state. And at the far end, our entertainment sector and our mining sector are the two real lagging industries when it comes to comparing against those industries nationally. So zooming in a little bit, this is showing year-over-year employment growth as of March. There's some surprising upside here where transportation and utilities is adding jobs year over year. Company headquarters are adding jobs. Federal government is up, finance is up. And then I think the real surprise for me is that retail trade is also up year over year. But when we take a look at the downside, it's that tourism sector that continues to suffer the most job losses year over year. So in absolute terms, the blue bars, we see the greatest volume of jobs lost in hotels and restaurants, in government, in arts, entertainment, and recreation. And in fact, when we zoom into just accommodation and food services and arts, entertainment, and recreation, we mash those together to describe tourism. Together, it's leisure and hospitality. And those two sectors account for 2/3 of the jobs lost in Colorado year over year in March. So let's zoom into that for just a moment. And you can see that early on during the pandemic, this industry lost about half of its employment. It's gotten better as of March. It's down about 19%. So it's just less bad, but it's still really bad. But I described that 2/3 of the job losses are in this sector alone, which leads me to this discussion about the recovery and the timing of the jobs added back in Colorado. So much of our employment recovery is dependent on this industry getting back on its feet, which is so dependent on people getting the vaccine, so dependent on governments allowing these key industries to reopen, and so dependent on human behavior, people willing to take the plunge and travel again, get on a plane again, stay in a hotel again. So this is really the key industry that we're watching to understand the timing of Colorado's employment recovery. But we are optimistic that 2022 is now the year that Colorado will recoup its job losses and reach a new employment peak. I've described this slide in the past as trying to break down employment by income cohort, just to illustrate again how different communities, how different populations have been impacted. So grouping high income industries together, industries paying above $75,000 a year, that's the blue line. Early on during the pandemic, this cohort lost about 3.3% of jobs, and now it's down about 1.4, 1.5% as of March. Okay, so it's recovered most of the job losses. But when we take a look at that lowest income cohort, the industries that pay on average less than $50,000 a year, they lost about 29% of jobs early on during the pandemic. And they've had sort of this rocky recovery where it improved, but then during the second wave of the COVID cases late in the year, we saw employment fall again, and now they're down just shy of 10%. So it's getting better, but still comparatively much worse job losses due to this particular recession and how it's impacted some of our hourly wage industries. So another way that we like to describe the communities is really these physical communities and how they have performed through this recession. And one way that we take a look at this is the retail sector, retail sales tax collections. And I think this really illustrates how this recovery has impacted Colorado communities so differently. So year over year, now we have Colorado statewide totals. We know that as of February, Colorado sales tax collections were down just 0.4% on a 12-month trailing basis. For the month year over year, February was down about 2%. But take a look at these municipalities across Colorado as of December. So that's where we have the most consistent data is really for the end of the year. So places like the Denver metro region down 4.7%. Boulder was down nearly 9%, but Superior was up about 18%. And Longmont was up 4%. So there's been all of these microcosms of economic performance where it's been dependent on the type of retail that communities have. Are they big box stores? Are they sort of Main Street retail? Are they dependent on a tourism base? Are they dependent on daily commuters for a lot of their sales? Are they dependent on a captive student university audience? So even though we see the state retail picture sort of doing okay, we're seeing much different picture depending on the community that you're looking at. In terms of home prices, this follows very much the employment growth chart that we had. So again, this is Southern Colorado and Western Colorado sort of outperforming in the state, and the North Metro Front Range underperforming in the state, but it's still a really strong home price. Even if you zero in on Boulder here, that looks to be about 3.5%, 3.7% year over year growth in home prices. That's exceeding inflation and it's exceeding wage growth. So still not a sustainable home price growth rate. Certainly an issue when we talk about affordability, but it's sort of interesting that those four metro areas are lagging the nation when it comes to home price growth. Building permits, we're seeing growth really across the state. This is, I would say, a story that we got wrong in December, where we thought building permits would pull back a little bit in 2021. They're still going full throttle as of February, and we see so much demand for housing, so much home price growth, that it's really unlikely to see this let up anytime soon. So I'm going to close out by talking about just a few indicators that we're watching that give us more of a real-time indication of what's going on, and maybe even a few points of optimism here. First, jobless claims, people signing up for unemployment. We saw the spike last March and April. We saw it come down. We saw the second wave of COVID cases really lead to a second wave of jobless claims. We saw an enormous amount of fraudulent activity in the state, but we're sort of working through all of this, and the initial claims are on a downward trajectory again, still about 4 times the average, pre-pandemic levels, but they're moving in the right direction. And that's true with continued claims as well, about 3.7 times the normal average, but still, concerning levels, but moving in the right direction. One thing that we've measured over time, that I've cut this different ways over the last 40 years, and we see the strong positive correlation between young businesses and employment growth. You can see that Utah is sort of the leader in this space. We're about fourth best in the state in this space, and we measure new business growth in the state. Those are our young businesses, and that new business growth, the new entity filings from the Secretary of State's office, indicates that we are primed for more growth in the coming couple of years. So there's been strong entrepreneurial activity, and given this long run correlation, I think that suggests we're going to have more strong employment growth once we move through this pandemic. Another metric that we're watching is business failures, business dissolutions, business delinquencies. And so I put up here the delinquency filings from the Secretary of State's office. This is showing January of 2020 through March of 2021. And so, we would think that enter a pandemic recession, we would see a lot of business failures. And in fact, what we saw, and delinquency filings are sort of a prelude to a company going out of business. So they're delinquent with the state, renewing their business status. And so at that juncture, they could be going out of business, or they could just be late, and they can resolve that with the state and get back in good standing. What we saw was delinquencies actually went down as the year progressed last year, and they even continued down as we walked into 2021. So there's not sort of this concerning level of delinquencies, which may speak to the power of PPP and other federal programs that helped companies weather the worst of the pandemic recession storm. Foreclosures, another one that's down dramatically year over year in 2020. We don't have any 2021 data yet. But it's the opposite of what we would normally expect during a recession, right? So you can compare that to the Great Recession, where we had just an enormous number of foreclosures in the state. And I think this again speaks to some of the federal and state programs that kept people in their homes and helped quell another foreclosure crisis. Bankruptcy filings, another metric that we would think would tick up during a pandemic recession. Actually, we're down slightly year over year in 2020, and they were down each quarter of 2020 year over year. So it wasn't like a single quarter drove this number down, it was throughout the year. So that's another good sign. So there's not a lot of great evidence of businesses failing yet at this point, but that's all of these could be lagging indicators, and we could see some more of this activity in 2021. Lastly, I think a really optimistic point here is for the last 18 years, we've been asking business leaders in Colorado about their forward-looking outlook. So looking at 1 quarter and 2 quarters. And we ask them about sales and profits and hiring and capital expenditures and the state economy and the national economy, and we mash all those together in a single index. And this last survey that was just published on April 1st showed that that business leader optimism reached near record levels 1 quarter out, so for the second quarter of 2021, and then reached record levels when we look 2 quarters out to Q3 2021. And so that shows that I think that a lot of these individuals see a light at the end of the tunnel. We ask them about returning to the workplace, and they plan to have employees go back later this year, still probably modified, but having a greater office presence than they had before. They see benefits to productivity for going back. And all of these business leaders, the general consensus was the decrease in COVID cases, the decreasing government restrictions on their businesses, and the increase in vaccinations all sort of led to their positive outlook. So that really brings me to the end. This last slide here is showing you sort of how Rich and I have thought about headwinds and unknowns and tailwinds, and I think a lot of these are pretty intuitive, but it gives us a framework for thinking through the positives and the negatives. So, of course, the decrease in COVID cases and the increase in vaccines all help, but COVID variants, sort of persistent levels of unemployment, all of those things hurt. And then there's these unknowns about human behavior, about returning to the workplace, about work from home, about how people commute in the future, how they vacation in the future. So I think all of those things are things that we're trying to keep a really close eye on, to not understand if we'll recover from the recession, but understand when we'll recover from the recession. So with that, I think we have ample time for some Q&A. So I'll stop sharing my slides here. Just want to thank you for your time.
Thank you, Brian. Our first or if anyone has questions, please submit them through the Q&A interface at the bottom of your screen. Our first question is, are you anticipating long-term or permanent structural change in industry hiring after the pandemic?
Well, this is a really interesting question, and we've actually been having some board and company get-togethers just discussing this issue about different industries. The university hasn't come out with their sort of formal policy, but there's definitely companies that are suggesting that if they don't offer remote possibilities for some number of days per week, that they're going to have a hard time hiring workforce. So it's hard to take away from people what they have gotten and in many cases feel good about. So I do think you're going to see, especially for certain industries, you're going to see a higher percentage of remote working. What that means for actual demand for office space, I think, is the second piece. Or does it just let companies stay in the same space now with a little bit more distancing? But there will be some pieces, and as I alluded to in my comments in the beginning, that then translates into, you know, real estate demand, but it also translates into public transportation and public transportation systems and ridership, and frankly, downtown people consuming meals at restaurants and so on. So it's got, you know, secondary effects, if you will.
Thank you, Rich. Our next question comes from Glenn. Over the last 10 to 15 years or so, is there a specific reason there was so much influx in population? Was it a function of younger people moving to Denver? Was it a function of people moving out of Los Angeles?
Well, I think people who believe in amenity-based migration and creative class types of analysis certainly believe Colorado was one of the places that was seen as higher quality of life, but also having ample job opportunities and, you know, quality business environment. So young graduates or young people who wanted a better quality of life and outdoor life, but also didn't have to give up the fact that they weren't totally in some remote place that didn't have employment. They could do both in Colorado, and so that was one of the, I think, the main drivers. Colorado is, you know, as a beautiful state. How that exists going on, I'm responding to a question from Cliff, and he said he's surprised to see that the migration numbers have not spiked up. I think the actual measurement of that lags, frankly, in the state demographic data. And we've seen, frankly, a number of people talking about the fact that there have been out-migration from their areas to other, even more remote areas. So we'll see where that all nets out, but there certainly seems to be a huge exodus from parts of the coast to places like Colorado, although other recipient places like Idaho are seeing a lot, Arizona, Florida, we've seen a lot of migration to some of the warmer amenity-rich places.
Thank you, Rich. Our next question is, on the slide showing rank of industry with mining all the way on the right, how are they referred to as best or worst? Is it job loss?
I couldn't hear that question, Laurel. Can you please repeat it?
She was
Yes.
asking about your ranking slide where you compare the industries by state rank. Just an explanation of that. So the answer is, it's the relative rank of the state's job loss compared to all the other states. So mining has lost more jobs in Colorado than relatively than almost every other state. The rank is in the 40s somewhere. So it's a relative positioning. Many of those industries are negative in the country, but we're in that case, we're more negative, if you will.
Thank you, Rich. Our next question comes from Seth. Was sales tax data adjusted for that portion that retailers were able to keep?
That includes the portion that they were able to keep. So I assume you're talking about the vendor fee and how that vendor fee was capped in 2020. And so that includes both the sales tax data as well as the vendor fee that the state gets. So in a way, that's sort of almost suppressing the growth a little bit if the state is only getting a smaller portion of that vendor fee that they got in the past because it's capped. So that shows that it's even higher for the state of Colorado. The jurisdictional level data that I showed there is each city's growth year over year. So that's sort of dependent on each city's tax base and tax rate.
Thank you, Brian. Our next question comes from Christian. Any forecasts for the mining industry in Colorado and the rest of the country?
Well, I think we do see a recovering oil sector. We're seeing some recovery in prices, which will help the industry recover. So, I think that we see it as a more favorable environment generally in 2021 than it was in 2020. And what's interesting is if we take a look at some of the very energy intensive communities around the country that have a lot of these company headquarters, places like Odessa and Midland, those are the communities that are performing the worst in the country right now in terms of job losses year over year. And so those places are really eagerly awaiting a recovery in that industry more than even a place like Colorado. But I think that we see it as less hampered by price, certainly. As the recovery continues, we'll see more demand for that commodity, which will help the industry improve. But then we have sort of a regional discussion in Colorado where we're under a different regulatory environment than we were 10 years ago or 5 years ago. So I think we'll continue to see perhaps some regional differences when it comes to the industry. And that's what I think will be sort of interesting to watch over the next year or two.
Thank you, Brian. Our next question comes from Sandy. Colorado in recent years has successfully attracted significant new companies to the state. Looking forward, which industries have the most appeal to relocate operations or headquarters to Colorado?
Oh, real crystal ball. Well, I think what we're seeing is, the state, we're still seeing a lot of interest. And I think it's industries that have, I hate to say this, but pay above average wages and rely on an educated workforce. So we are seeing a lot of interest in the life sciences space and biosciences and life sciences. And I think that relates to a number of things, but certainly Corona and all of the medical research that's gone on in the last year. But I don't think I think another piece of that is actually medical marijuana is sort of part of that larger portfolio. And then certainly aerospace continues to be strong. We appear to be really strong in cloud computing, and we've had a lot of professional scientific and technical firms really growing rapidly. So we'll see where that goes, but I think those firms, a lot of those firms need a certain level of talent, and in many categories we have that level of talent. And some of those firms, as we know, have been moving from places that have even higher cost of living than we do. So that's sort of the second piece.
Yeah, and I think that's where I was going to go, Rich. the higher cost of living sort of prices us out of having some of those lower wage industries grow in the state. If you think about a data center or something where you're looking for workers between $15 and $20 an hour, that space becomes a lot harder in Colorado because of the cost of living and the higher wages that we have here.
Thank you both. We're moving into our final two questions. Our first one comes from Doug. Why is the stock market not being impacted by COVID, and when do you anticipate interest rates will rise?
So the stock market is being impacted by COVID because it's being impacted by all of the attempts to, in my opinion, the stock market is being impacted by COVID because of all the stimulus that's gone on, a huge amount of monetary stimulus, and then of course all the fiscal stimulus I talked about on the front end of the presentation, I think is propping up asset markets. So it started with not seeing, we saw a big negative impact early, if everyone remembers, and then it got wiped out as more and more liquidity was out there, and we were able to sustain it. Now I think it's actually in sync, if you will, to some extent with the booming growth that we're seeing in the economy. So at this point, the price levels that I thought were really too high now seem to be not crazy high, given how fast economic growth is going to be in the next year or year and a half. I can't tell you that Chair Powell is not telling you what he truly believes. So he keeps saying we're not going to see interest rates rising. I think it's going to be interesting to see if we do see inflation rates that crest up into the high 2s to 3 range, how long they'll be patient, especially with how fast the GDP has recovered. And we didn't go into this, but there's bottlenecks in the system still. The supply chain is not fixed yet, and anybody who's tried to buy an appliance knows this story. It's not just pent up demand; it's supply chain issues from around the globe at this point. So I do think they'll have to react at some point if inflation gets too high. And so when is that? I think so. Long-term rates are cresting up, although I don't think you're going to see them go way above 2%, meaning 10-year rates. But the short-term rates, I think they originally said 2023. I think they're going to move that up into 2022, just in terms of the short-term rates, maybe even end of 2021, beginning of 2022.
Thank you, Rich. Our last question comes from Seth. How concerned are you about inflation possibly overstimulating the economy?
Concerned. I somewhat joked about this in the beginning. I think I said it at the time, even before the vaccine was widely getting rolled out. I thought that the need to continue to provide that much stimulus to certain groups in the society that never lost their jobs just seemed to me to be crazy. And I do think that's driving really high levels of demand. Even with groups saving, there's still really high levels of demand and pent-up demand. And anybody who's trying to buy plane tickets now to certain places, if you're watching, they're doubling within weeks or multiple weeks. So you're starting to see, really significant price inflation in certain areas. So I do think it's a threat, Seth. And whether that ultimately winds up being a threat to the recovery, and if it is, it's probably because we start to see higher interest rates because the Fed just feels that they can't wait. We start to see higher long-term rates as they don't do easing, and then we start to see at some point higher short-term rates, so we get the typical investment effects of higher interest rates, meaning negative investment effects of higher interest rates.
Thank you, Rich, and thanks so much to everyone for joining us for today's presentation. I want to give another big thank you to Brian and Rich for this great information. At this time, we invite you to provide your feedback on the webinar by answering the following poll question. On a scale from 1 to 10, how likely are you to recommend this webinar to a friend or other CU Boulder alumni? We thank you in advance for submitting your feedback. As a reminder, all webinar attendees will receive an email tomorrow with a link to the recording of this presentation as well as a survey. To view upcoming webinars as well as previous recordings, please visit our website at www.colorado.edu/business/alumni. We hope you will join us for our next webinar, which is tomorrow, as Nina Campbell presents on hazards and disasters in the context of COVID-19, implications for marginalized communities. In the meantime, have a great rest of your day. Thank you for your time, and go Buffs.